The stock market has been going wild with excitement, hitting new highs this year, and the culprit is that artificial intelligence has sparked erratic investor sentiment that we haven't seen since the dot-com era. Now, analysts are issuing stark warnings amidst the exuberance that this could be the largest bubble in U.S. history, on the verge of bursting. The market now rests on the shoulders of just 7 tech giants, and if they stumble, the fallout could hit the entire economy as well as investors' portfolios. Now, by any measure, the market is now overly concentrated and is in fact the most overvalued by multiple measures of any other time in its history, even preceding the crash of the Great Depression in 1929. Nvidia is the chipmaker powering much of AI's infrastructure, and it accounts for about 8% of the value of the entire S&P 500 index, which is a larger share of the market than any company has held in the past 35 years. This summer, they crossed a historic threshold and became the first company worth more than $4 trillion. Now, there are 9 other U.S. companies valued at over $1 trillion, and all but Warren Buffett's Berkshire Hathaway are tech stocks. Through July, the information technology sector was led by Nvidia, Microsoft, Broadcom, Palantir Technologies, and Oracle, and they accounted for nearly 54% of the S&P 500's total return. Nvidia alone accounted for 26.2%. Another tech-heavy sector containing Meta, Netflix, Amazon contributed 15.4% of returns, and that means almost 70% of the index's total return came from just 2 sectors. If any of these companies fail to deliver, it could knock the legs right out from under the entire market, and experts are warning that valuations are increasingly detached from reality. They're actually reaching extreme levels and building in extreme risk. For example, Palantir was the top performer in the S&P 500 this year. It saw its stock price gain more than 100%. Its price-to-earnings ratio of more than 570 is about 20 times the average for the S&P 500. And as The Economist noted, Palantir might be the most overvalued firm of all time. Now, the most interesting piece of this entire story is that MIT ran a study and found that 95% of companies see no returns at all from generative AI. The findings revealed the following: despite $30 to $40 billion in enterprise investment into AI, most organizations got 0 return. Half of AI projects ended in failure. While 80% of these businesses explored AI, only 40% actually used it. And just 20% of AI initiatives reached pilot stage, and only 5% made it into production. Furthermore, AI would increase U.S. productivity by about 0.5% and GDP by just about 1% over the next decade, which is a fraction of the optimistic forecasts that are being put out there. And the market sentiment shifted harshly upon this report. The NASDAQ fell, Nvidia shares dropped about 3.5%, Palantir lost $73 billion in market value, and in total, the U.S. stock market lost $1 trillion in just 4 days as tech stocks sold off. Now, the long and short of it is that the AI bubble today is bigger than the IT bubble in the 1990s. The AI frenzy has many observers recalling the dot-com bubble. OpenAI CEO Sam Altman himself compared today's valuations to the late 1990s, warning that too much money is chasing unproven models. Ray Dalio echoed this caution. He says, "There's a major new technology that certainly will change the world and be successful, but some people are confusing that with the investments being successful." Apollo Global Management chief economist Torstein Slok said that the AI surge could eclipse the internet bubble of the 1990s, and he pointed out that the 10 largest companies in the S&P 500 are now more overvalued relative to fundamentals than they were at the height of the dot-com era. Now, back in 2000, the top technology stocks accounted for 15% of the S&P 500. Today, the Magnificent Seven make up more than a third of the index, meaning a fallout of a crash would be even more dramatic. And another worrying parallel is the massive infrastructure spending. In the 1990s, telecom companies overbuilt fiber optics networks that bankrupted businesses when that demand fell short. Today, AI companies are pouring hundreds of billions into data centers, and projections show that $3 trillion will be needed by 2028. Now, if AI adoption doesn't scale as expected, much of that money may never yield returns at all. And if the AI boom proves to be a bubble, the fallout could outdo the dot-com crash in a major way. Global venture capital poured $131.5 billion into AI startups in 2024 alone. Much of that is at risk if expectations were to collapse. Companies like Nvidia could see trillions in market value erased, and trillions more in planned infrastructure spending could be scrapped. The result of this would be a market correction that could wipe out, again, trillions of dollars across stock portfolios, retirement funds, and corporate investments. AI may change the world over time, but history shows that markets can move much faster than reality. Now, when expectations exceed results, bubbles form, and of course, bubbles burst. And that's why diversification matters so much in these current conditions. If you're concerned about how an AI-driven bubble could impact your retirement savings, you're watching the conditions, you're getting a little worried, I'm Mackay Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical precious metals into your retirement accounts or into your portfolios can give you the hedge that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.